Thank you all for joining us this morning. It's the opening panel. I'm Nandini Sukumar. I'm a journalist at Bloomberg. I cover the industry. I know many of you in this room. Most of you are from exchanges. A few of you are lawmakers or politicians, and a couple of you, the very brave ones, are customers. We're here this morning to talk about a very simple subject, what are markets for? And we're going to have a conversation about it. We're going to have a debate about it, really, after a pretty explosive year for the markets and the week after the Greek election. It's also the day after NYSE Euronext London poached Eurotunnel from the main market of the London Stock Exchange, and a day after CME Clearing Europe was all over Germany, all over Frankfurt, chatting perhaps to Eurex clearing customers. So to get us started, Larry Tabb, right over there, is going to give us a little presentation, and then we'll click into Q&A. I'm not going to introduce my panelists because you've met them all. I should introduce Christian Katz. If any of you don't know who he is, you all have been under a dark rock for the last decade. Christian heads the Swiss Stock Exchange. And now, Larry. Larry, that was great fun and very insightful. I'm going to go straight into Q&A, actually, and ask you all in the first instance, addressing Larry's point about a crisis of confidence. What can you do to address it? Is rethinking regulation the answer? And of course, we're speaking to a room full of people who're dealing with MiFID II, who dealt probably with MiFID I, and some of whom may have seen the Investment Services Directive in its first incarnation. Is rethinking market regulation the answer? And Christian, why don't we start with you?
Thank you. I also wanted to thank you, Larry. It's very inspiring, makes us feel very good to start with. But I think you raise a number of very important points, and I believe that one of the things that is striking in our world is there is negligible research done on the effects of regulation on markets. And markets are usually in academia, they are supposed to have three benchmark variables they need to fulfill, which is low transaction costs, high liquidity, and high transparency. And the effects of regulation on these three factors is hardly ever researched. And I would think, as a starting point, maybe we should think about having the De La Vega Prize of this FESE given to somebody who kickstarts this a little more. But I think in this sense, you know, this is a key variable. And I think one of the things you pointed out is the crisis confidence when it comes to the functioning of markets, not just on the secondary side, but also on the IPO side. And at the same time, the second point you made, which is a little bit a point apart, is the delisting of companies that nobody writes about either, because it's so funny and interesting to write about IPOs, but it's not very exciting to write about companies leaving public markets. And here, I think, is the link to this regulation forcing companies off a market. And I think this is a major point we should pick up, because I believe the public doesn't know the cost of going public and staying public. Right? The cost of going public is usually very low, but the cost of staying public is being put higher and higher and higher with every regulation that just hits at publicly listed companies versus privately held companies. And this is why, besides M&A, besides companies folding, going bust or into Chapter 11, besides companies reducing their secondary listings, the fourth reason why companies leave stock exchanges is because they simply do not want to carry on with the burden of regulation, legislation that only hits out at public companies. So I think we have to help legislators in each country to make the rules, the balance between public burden and privately held company burdens level out.
Aline, do you want to pick up on that? I mean, obviously, I'm very pleased that you're looking after my interests and everyone else's in this room as the retail investor. But I mean, do you agree with Christian? I mean, the burden of regulation is great, and there hasn't been enough kind of quantifiable studies on the impact of regulation for the retail investor or the investor in general, the cost?
Well, I think the argument, to which we've come to this is that the crisis was because of a failure of regulation, too little regulation. Now, the question always is to get the right balance. I agree with that, but to get the right regulation. And to a certain extent, if you've had, decades of under-regulation or light regulation, then we're trying. I know that we've been accused, and I will be quite frank about this in the Parliament, of going too far. And we've been accused of regulating areas like hedge funds, which didn't cause the crisis. But the argument, I think, is that we've got to try and get investor confidence back. We think that a regulation, that demonstrating that the markets are better regulated does give more confidence. But I do agree, actually, that we have to look at the unintended consequences. And we have an approach now to say, let's have an impact assessment before we move towards it. But I think impact assessments, ex ante are always very difficult to carry out because you don't really know what the result will be. So then we're in the domain of saying, well, we do it and we ex post evaluate it, and then maybe we've already had the unintended consequences. So I think it's a very important debate, and I think it's one that is, that in a sense for us, we're trying to say, particularly in this area of the financial regulation, not that we need more regulation, but that is what is happening. We are getting more regulation. It should be better. It should be more focused. But I think for us, and I speak for my political group, is that it has to cover all of those trading. We can't have a situation where some are in the regulation, some have the advantages, the competitive advantages of not being regulated. And from that perspective, I think it's a debate that will be ongoing, I think. And I very much agree also with the presentation in saying that you can't focus at looking what's causing the problems by saying there is an issue with high-frequency trading. That's happened, as you said, because of the market structure. But now we look at changing the market structure. And again, it's all about a question of confidence, I think.
So if it's a better regulation that we're seeking, as opposed to more necessarily, let's look at the impact of kind of technological or technology outages in the last year. And I'm not signaling out anyone here. Obviously, we had BATS with the IPO. We've had NASDAQ and Facebook. We've had NYSE. We've had LSE. There is no exchange, really, that has been free from this. And that's very damaging, people would say, to investor confidence in the market, though it's a technical reason. What is the answer? Larry, why don't you have a go at that?
That's a very good question. I think if you go back over the last 10 years, when you used to talk with the exchanges, they were all about being up 100% of the time. 99.9% wasn't good enough. However, the focus on cost and the focus on trading costs has reoriented the exchanges to really think more about speed and cost rather than certainty. And we've seen all of the fault-tolerant platforms be ripped out of most of the U.S. exchanges and in place with basically very low-cost, high-speed infrastructures. Now, that said, the redundancy built in because of the competing market structures is supposed to work that if one goes down, the others take up their slack. And mostly of the time, that's worked pretty well. Except on IPOs when one exchange dominates that process. I don't know what the answer to that is. It's hard to regulate. You will have this infrastructure. And so I think you have to let the market focus on that. And to a certain extent, when one of the exchanges or one of the entities gets a black eye, it doesn't reflect good on that exchange, and they're going to focus on trying to fix it. So by regulating it, are you, solving, this problem with the sledgehammer? I don't know.
Do you have anything to say?
Yeah, I don't know. I'm wondering whether, Larry, you have any evidence of that it is true that the systems uptime are less than it has been. And just take the Facebook thing. In reality, this is an American thing because the IPO are running in another way than in Europe. So it was not continuously trading being the problem in the US. Right. That worked.
Right.
They were traded 500 million shares in Facebook in continuously trading from 11:32 to 4 o'clock. So the system worked. It was in the IP cross, which is done differently than in Europe. The problem occurred. So I'm not sure that you really can prove that that there been a change in this area. But coming a little bit back to your initial question, I mean, what create confidence? I think that in many aspects of life, it takes a very long time to create confidence. It's very easy to lose it. And I think that's where financial markets are today. I think that retail investors, especially to a large extent, have lost confidence in the security markets for many, many reasons. And unfortunately, I also believe it will take some time to build it up. And there is not one easy question on that. I think partly it is more regulation, because I definitely believe that it was lack of regulation which was part of the explanation of what we saw in 2008. But still, we should always strive also to make sure that we have better regulation, so we find the right balance in things. But it goes on. I mean, it is a question about market structure. You raised the question about the IPO process. And one could guess whether the reason for only having 22 Dutch auction IPOs, perhaps it could be because the one who conducts the IPO process earn less on such a process. And so there could be a very easy explanation on that. I mean, why are some banks claiming that you need to be very big before you can go into an IPO? Of course, you use the argument about liquidity, but it could also be that it's easier to get the high fee. So, I mean, there is a lot of explanation. Some of them, I guess, is guess more than it is evidence. So I think my conclusion is a little bit, we need to create the confidence again, and I think everybody in the financial market need to be focused on that, because all of us need to do an effort to get it, the confidence back.
So, easy big picture question, how do you create confidence? Arlene?
Oh, well, I mean, again, I don't think it's just regulation. It's not just market structure, actually. I think if you look at the current environment, that's why I also mentioned the fact that, you know, people have a perception that we're in a crisis, in an economic crisis. And so that also means governments exercising leadership to deal with that. And I think if you talk to people on the ground, their view is actually, well, why should I invest at the moment? And particularly in those countries, like, you know, in the countries that are having severe consequences of that, you know, they're moving money out of the country, which I think for me is a very severe kind of cause for concern. And I think really we've got to inject back general confidence in the economy of Europe and globally before you'll get people to think about what they're going to do with their money, if they have any spare money at the moment.
Well, essentially then you're suggesting that if you're an investor, if you're a retail investor or any kind of investor and you're worried about your job, there's nothing that's going to give you confidence in the market apart from feeling secure about your job.
No, I don't think that. I think it's a combination of factors. I think that people, you know, have to see that that we, rather than talking in terms of the Eurozone crisis, we have some action, that governments do take decisions. We certainly think that there needs to be a stronger role for the ECB in terms of sorting out the crisis. And I think once you get people seeing that there is change happening in a positive direction, that will have an impact, I think, on whether people decide, not just to decide on whether they invest money. I mean, we have an issue in Germany where people are not spending money either. They're putting it in bank accounts. So, you know, there isn't a virtuous circle, I think, of spending. I don't think regulation is the only answer. I think regulation is not a silver bullet, but we are obliged, in a sense, to deal with the fallout of the crisis by toughening up regulation, but that, I don't think in itself will inject confidence.
I think to add to that, I think it's a very good point. It's not just market structure and regulation. I believe in general as a business, and we as market operators, how do you build confidence? Often is do good things and then talk about them. I believe that, but there has to be a gap in between doing good things and talking about it, because if you talk too early about it, you're not so credible. But I think, you know, as marketplace operators, some of them have to just, you know, sort out some of the system issues they have, whether that be circuit breakers, whether that be certain processes that are not instilling a lot of confidence. But also then it's not just the retail investor or the end investor on one side and market marketplace operators on the other. There are intermediaries in between, and some of the issues are, for example, over-fragmentation of orders, right? Where, you know, like you have a $1 million order that gets split into 100 pieces of 10,000, and actually the investor who wants to buy $1 million worth can easily execute that in one trade, because like a market like ours, we have $1 million on average at the touch in our large stocks. But it gets fragmented, and of course, while it would have no market impact at $1 million, which is way above large in scale, you know, it still gets fragmented. And of course, after about 20 orders of 10,000, you know, the market starts picking up on the order. So, and I think, you know, also our intermediaries and friends on the banking and the dealer broker side, they need to maybe a bit more radically change some of the things they operate, and then actually carry that message once it's worked under a new and better regime, carried out to the public. And this is how we can regain trust.
Larry, do you have anything to say on that?
I think it's, I think, you know, in terms of what Christian was saying, in the U.S., the average trade size is 300 shares, not even near 10,000. 10,000 would be really good. In fact, the average retail order is actually bigger than the average institutional order, because the institutional orders are broken up into such small pieces, and that's why the dark pools become very important for the institutions, because they don't want the high frequency firms to to try and determine what my order size is and get in front of me, and it becomes very challenging. How do we instill confidence? I think the issue is getting back to governments. We need the governments to settle down. We need to have more certainty in what's going to happen in Europe. We need more certainty in what's going to happen in the States. We need growth. People need to have jobs. Companies need to feel comfortable that the markets work. And actually, I think it actually, it works from the real economy back to the markets rather than the markets to the real economy.
Hans-Ole, do you disagree?
I just want to say about this with the dark pools that I spend a lot of time to talk with these big investors and also some of the brokers who help them. And the reality is that even there, you're not able to execute the big blocks.
The high-frequency firms are in the dark pools, just like they're in the public.
So what is happening is a little bit when institutional investors want to sell a block, that block is, as Christian described, is broken up on a lot of trading venues, including broker networks and dark pools. So sometimes I have my difficulty to understand the argumentation for the dark pools. The only thing I know is that very often the ones who run a dark pool earn more money on execution than an exchange do. So that could be the reason.
Mm-hmm. At this point, I'm going to say, does anyone in the audience have a question? No?
Can I be a bit provocative, though?
Yes,
actually?
please go ahead. That would be great.
Because I think in terms of how we think about these issues, I deal with these issues in a broader view. I don't only sit on the Econ committee. But when I went on delegation to Singapore and Hong Kong, and we met with European businesses there, the one point they made to us was, and I'm not saying this is Bloomberg, although I did meet with Bloomberg News when I was there, who filed a very negative report, is that they said to us, please stop talking us down, actually, because it is difficult for us in terms of trying to build confidence, is that every piece of information that comes out from the media in general is we're in crisis and we're not going to get out of it. And that's why I'm pretty provocative in saying I think it's not a Bloomberg issue specifically, but I do think that their appeal to us as businesses was to say, help us to actually have an upbeat approach to this about where we're going to get out of it, rather than saying that we're going to go further and deeper into crisis.
It's journalism 101. If it bleeds, it leads.
Yeah, that's right.
But going back to your point, I mean, it's, how do you write good things or positive things or happy things when you look around and it's a sea of red? Let's say it's your pension fund and you're thinking of retirement, you're thinking of your grandchildren, and it's a sea of red and you can't afford to retire. How do you write that positively?
Well, I think you write the bad and the good. I think when good things are happening, and there are some good things happening, then I think that it's important to report that as well. And I think that's a general problem that we have with the media, is that as you said, if it bleeds, then that's the story you cover. And in fact, some of the journalists who spoke to us agreed that is their job to cover those issues. But I think you know, we have an obligation to try and find the positives in the negative, actually, because that, again, will begin, I think, to put confidence back into people who will then put confidence in the markets.
Christian.
I don't write.
But you're allowed to talk today. So let's go back a little bit, Aline. Like, have you been surprised that there hasn't been more press or writing about, you know, potential insider trading, market abuse, given a time of market crisis or turmoil is often a great time for people to write, an interesting time for people to write about, you know, what is bad and wicked and wrong in the market.
No, I think that's important. I think it is important to report on market abuse because that's not a confidence issue, that's actually a deterrent issue. And I think we've tried to deal with that. In the regulation, we're saying very clearly that we do want to see more public information. We want to see more stories written about it. And in fact, when I met with the DOJ in the US, they said that's fundamentally important to them, that they want those stories to break on national television because they feel if someone sees, oh, hell, I'm going to jail for 12 years, I don't think I'm going to risk that. The difficulty we do have in Europe is, though, that you know, we get into this situation where we continually have a debate about the privacy, people's privacy, and what you can report and what you can't report. And, you know, I think we do have to respect privacy and data protection, but, you know, we have to get the balance right. To what extent do you want to protect investors in this and deter market abuse, or to what extent do you say, well, criminals, because they are criminals, should take the rap and they should be made public if they've committed an offence?
We've run out of time, but Hansel, do you want to sum up, make your closing remark, whatever?
No, well, to sum up is probably will take too long time for Judith to be silent. So let me just say that that I think talking about what could be good to write about is in reality that I think with the MAD directive we are definitely on the right track when it comes to do something about insider trading. I mean, I'm amazed that we have not at least seen or nobody have found a major scandal when it comes to insider trading, because it's too easy today to do insider trading because you can more or less trade the report where you want and nobody will catch you, I would claim. So I think you're definitely on the right track. There is something a little bit about who should be the primary regulator. We can fix that in the coffee break, hopefully. But I think that could be something to write about because I think this is very, very important for the confidence going forward.
Just when it's getting exciting. Thank you all for joining us, and thank you all to my panelists who've been brilliant.